One area I note you are staying away from is private credit. Folks have been talking about leverage upon leverage upon leverage in private markets, especially private credit. And I got to ask you bluntly, is that the place where potentially we could have a credit event emerge that could just undermine this entire market?
Well, that's a great question. I don't think the private credit market is big enough to cause anything close to a systemic failure, but it can cause pain for individual investors. I was a lender at Bank of America SunTrust prior to the wealth management side, and I remember how diligent you have to be with pricing loans. Banks turn a lot of loans down. They don't turn them down because they're foolish. They turn them down because somewhere the credit doesn't make sense from a cash flow or from a secondary collateral standpoint. To think that private lenders come in, step in, and can across the board find very strong credit quality companies that are willing to pay a higher rate of interest, and those do not carry more risk, that's a fallacy. There is more risk. That's why these companies pay more interest, and in a booming economy, that can be fine. But when the risk hits the fan, those credits, remember, banks, if they have more than 1 or 2% of their loans go bad, they don't make a profit. So I'm very concerned about private credit. I think they might have stretched a little. I think these entities that package it and sell it don't retain a lot of the risk all the time, and they collect fees and they move on to the next deal. So I think investors should be very careful about private credit. To me, it's a Wall Street contrivance. At its worst, at its best, you have to stick with the best issuers. But across the board, I'm cautious on thinking private lenders know a lot more than traditional bankers.